Hey, Wilf, thank you. For more on the financials and what's ahead for the sector under the Biden administration, we are joined right now by Ron Kruszewski. He is Stifel Financial President and CEO. And Ron, what Wilf just said, that last point about the banks being up 40% over the last 3 months, there were some very high expectations heading into this earnings season. You think there's still some room to run. Why is that?
Well, for the banks, look, you can just see it's activity levels, and you can kind of parse the results a little bit. You don't see a lot of net loan growth, but you see a lot of activity in these universal banks. So when you see what J.P. Morgan posted and Goldman this morning, you're seeing tremendous market activity, which is the result of almost redoing the economy. All that activity runs through financials. So the financials are very busy, and I think they're going to be very busy in 2021. Activity levels will be high, in my opinion.
How much of this is the idea that we're going to see a lot more stimulus spent, and that means we'll see fewer bad loans?
Well, certainly the fewer bad loans is a result of a tremendous amount of not only stimulus on the fiscal side, but on the monetary side. And that is certainly driving the market. But, you know, as you think about it, I'm listening to you this morning, what makes me bullish about the market also makes me very concerned about the market. And the fact that we're talking about $5 trillion of stimulus, as the previous guest said, 25% of GDP, and $130 billion of QE, both of those factors are at full tilt, in my opinion, to this market. And at some point, this trade needs to balance out. We're not going to be pumping this market with this kind of fiscal and this kind of monetary stimulus. Personally, what I think is a real risk to this market, and everyone says it can't happen, so I raise my risk factor even higher, is a rather sudden increase in inflation expectations and long-term rates. That would take the air out of a lot of these stocks.
Yeah, that would be concerning for sure. Let's talk about what we can expect under this incoming Biden administration. Additional regulation probably high on the list. What do you think about Gary Gensler coming to the SEC? What do you think the signals that you're seeing at this point mean for any of these stocks?
Well, for sure, you're going to see higher regulation. I think that Gary, very experienced from his previous experience, and I believe that you're going to see a lot of movement on disclosure, ESG disclosure. There'll be a few factors in the in financials. I'm sure Reg BI is going to be get looked at. So it will be on the regulatory front through interpretation and enforcement and guidance for sure. But that's what you would expect. I've been CEO under 2 Democratic administrations and 2 Republican administrations, and we'll get through this fine. So I'm not overly concerned about a regulatory, cliff that we have to go over.
Yeah, Ron, there was a statement that was put out by Patrick McHenry. He is the Republican leadership, minority leader for the House Financial Services Committee. And he just said in terms of Gary Gensler coming to the CFTC, or coming to the SEC, he would be willing to work with him on things like cryptocurrency, where I think they see eye to eye. But he had a kind of strange statement that said he suspects that the Democrats are going to try and take a very partisan view and do things that are non-financial sort of regulatory measures through, I guess, the SEC and potentially other agencies as well. We've seen more of that with executive order over the last 12 years and beyond. What do you think about that? Just this idea that they could potentially be doing more that is non-financial and maybe outside the mandate instead of things that should go through the legislative process. Maybe that's just more of what we've seen for more than a decade at this point.
Well, first of all, again, I think Gary will be a good leader for the SEC. What he takes up will be interesting. I think what that comment is relating to primarily will be the SEC's approach on ESG and mandating disclosures and maybe mandating policies and things that companies should be doing on again, ESG that some may believe is outside the realm of what they're supposed to be doing, which is regulating the financial markets. And so that's what I think that concerns about. We'll see.
Ron, what makes you think the markets may be highly valued at this point? What kind of measurements do you watch? What is your biggest overwhelming concern?
Well, when the election came out, we thought that at Stifel, we thought the S&P would go to 3,800 within 6 months. It got there in 3 months. It trades at 23 times earnings. Our earnings are a little bit lower. By our analysis, it trades almost 25 times earnings. And so it's just it's a perfect, feels like a perfect brew for the market to maybe continue higher. But, there was a quote that you should focus on, and maybe you've talked about, that I think is bears looking into, and that was when the Fed Chairman Powell said last week that he anticipated the potential for, quote, exorbitant spending. And it's almost a corollary to, I'm not saying it towards markets, but to what Greenspan said with irrational exuberance back in the 90s, exorbitant spending. And I believe that that's a signal that there is a lot of pent-up demand in this economy. And when it gets unleashed, you could have pockets of inflation, and that will be concerning, both to the bond market and I believe the Fed. And in some ways, I think that was a signal that said, look, we need to watch this.
Yeah, it took years after Greenspan uttered irrational exuberance for it to really catch up in the marketplace. But you're right. It's something worth watching. And
it is.
We thank you for your time. We'll keep an eye on it, too. Good to see you, Ron.
Okay. Good to see you. Thank you.